Welcome, my name is Matt Garrett. I'm the chairman of TGG, and today we are going to talk about the super sexy concept of DSO, Days Sales Outstanding. I know it sounds super exciting. But before we do, I want to talk about the benefits of proper accounting because it ties directly into what we're going to talk about today, which is DSO. There are 4 benefits that when you do your accounting correctly, you will receive most of the time. Number 1, peace of mind. You'll know where you are, you know where you're going. You'll always have a good compass on your business. Number 2, increased cash flow. How do we get more cash out of the business that we're generating now? That's a common problem in small businesses, is that they can never quite get enough cash flow. Number 3, increased profits. We all want to increase profits. We all want to make more money, get our businesses to that next level. And finally, increased business value. Unless you plan to die at your desk, at some point you plan on selling your business, regardless of who that might be to, management, outside shareholders, an outside private equity fund, or take it public, whatever it is that you want to do with your business, you want to increase business value. So how does DSO work with this? What we're talking about here is Days Sales Outstanding. What does that mean? In layman's terms, it means how long it takes for your customers to pay you. Very simple. All it means, Days Sales Outstanding, how many days does it take for your customers to pay you? Once we understand this, we can start to manipulate it to increase cash flow, increase profits, and increase business value and get you better peace of mind. So let's take a typical business scenario. In this business, what we're going to have here is we've got a business that has $500,000 of a line of credit that they're paying 4% on every year. So they're paying $20,000 in interest costs every year to keep that line of credit, and they have a line of credit because they have to go out and do work. They have to actually spend money in order to go out and do services, sell goods to their customers, whatever it is, and then it takes them 30, 60, 90 days to get paid. And so the difference between when they've actually had to spend the money and when they get the money is what they use the line of credit for. And in this case, we're using a $500,000 line of credit, and it's costing them roughly 4% or $20,000 in interest. So, very typical business scenario. In this business, let's just assume for a second that they have $2 million in accounts receivable. This is money that customers owe them and have not yet paid them. And in the last month, they did $500,000 of revenue. How long does it take for these customers to pay them? What you do, the formula to figure out DSO, is you take the accounts receivable over the last month's revenue, and that right there is a 4-to-1 ratio. Then you multiply that 4 times the number of days in the period. In this case, last month, let's say, had 30 days. In this case, it takes 120 days for these people to get paid. And that's the equation. Quite simply, every customer is paying them in 120 days. Is that good? I don't know. It might be in certain industries, it might be horrible in other industries. But in this case, this is the business case that we have, and in all cases, it can get better. So let's think about all the different ways that we could possibly collect money faster. Well, first of all, we could just have our accounting in order and our invoices could go out on time. Second, we could have a good accounting department that just follows up on invoices. The squeaky wheel gets the grease. The more we can call, the more we pay attention to our customers, the more likely they are to pay us. Third, we could improve our product. We could go out and actually improve the product because people tend to pay for things they really enjoy and like. Number 4, we could put in our contract late fees, penalties, interest, all of those sorts of things. Fifth, we might just have better relationships with our clients on the front end and get deposits when we start the sales process. There are a number of different ways to do this, way more than 5. There are probably 20, 30 different ways that you can do this. But if you think about in your own business, are there ways, one of those or any other type of scenario that you could think of where you could somehow collect this money faster? Because if you can, and in this case, if you can collect this money 24 days faster or a 20% improvement, how much more cash are you going to have in the bank? It's a very simple equation. You're going to take 20%, you're going to multiply it by your current accounts receivable, and that's going to give you $400,000 in additional cash if you can improve your DSO by 20%. Impressive and incredible, because now you go, wait a minute, what do we do with that? Well, we take this $400,000, we pay down our line of credit, and what did we save? We saved ourselves $16,000 per year in interest forever. $16,000 per year in interest forever by simply reducing our days sales outstanding. It's an exciting concept here and takes us back to the original point that we had up here on accounting. What are the benefits of accounting? And what did we just do if we were able to decrease our DSO? Well, first and foremost, you have the peace of mind to know that you are actually going to get paid. Number two, you've increased cash flow by how much? By $400,000. You've increased profitability by how much? By $16,000 per year, which then has increased your business value by both the debt amount, because you no longer have the debt, and in addition to that, you've also increased by somewhere in the neighborhood of 5 times earnings multiple on $16,000, which is another $90,000, $80,000 worth of additional business value that you've created just simply by going out and collecting faster on the money you've already earned.